Welcome to Wealth Wednesdays. We go live every single Wednesday at 12 p.m. Eastern Standard Time to talk about all things building wealth related. We want to build your wealth, my wealth, everybody's wealth. We want to get smarter with our money and make better, more educated decisions. Really excited for the show today. We have Victor Menashe coming on in just a little bit. Very experienced gentleman in the world of commercial real estate. We'll be talking about the trends and what to look for in 2023. But first, I wanted to share with you a really interesting survey that Deloitte did. Deloitte surveyed the top CFOs of the very top real estate investment companies globally. So this isn't just isolated to the U.S., Canada, North America. This is global, and they surveyed an equal amount of people all over the globe. And I found this very interesting. Only 40% of the top global CFOs of real estate investment companies expected to finish this year, 2022, with higher revenues than last year. And then of those people, 33% anticipated cuts to expenses for a wide variety of reasons. So obviously, the very top dogs in the real estate industry, they are squeezing their belts a little bit tighter, and they're expecting cuts to adapt to what's coming in 2023. Now, what I wanted to talk about now was, well, what is actually going to be affecting the top dogs? Because what affects them definitely filters down to the smaller operators, and then all the way down to mom and pops and individuals, just operating their own investments. Now, typically on Mondays, we do Multifamily Mondays. Today, we're talking about everything related to commercial real estate for Wealth Wednesdays. So I wanted to talk about the 6 influencers, the 6 trends that I'm definitely watching out for in 2023, and also that these very top CFOs are watching out for too in the world of commercial real estate. So let's get right into it. So we are right on time when Victor joins us in just a couple minutes. So number 1, so I'll say trends for 2023 in CRE. Beautiful. Okay, so number 1 is geopolitical. So obviously, we've got a lot of chaos happening right now in Ukraine. We've got issues with Russia, and that's just the tip of the iceberg. And what a lot of these CFOs are saying is that it's resulting in food prices driving up, shelter, energy prices, because the supply chain is being squeezed, and that's causing issues across the entire economy. And this is causing a lot of issues now, and it's probably going to get worse heading into 2023. So that's actually the number 1 thing on the list for today is geopolitical issues. And it's just not stuck to Ukraine. Obviously, it goes all the way across the board, and geopolitics is number 1. Trend number 2 to watch out for is record high inflation. Now, we have talked a lot about inflation on the channel, especially this year, as things just keep getting worse and worse and worse. And here's an interesting thing. So in the U.S., rent was up 7.5% from 2021 as of October in 2022, because we're not finished yet for Q4 for this year. And the owner's equivalent rent of residences in the U.S. was up 6.9%. Now, obviously, that's a national statistic. Locally, that's going to be very, very different. But generally, the theme is inflation is a serious issue, and the Fed is looking to increase interest rates again, and that's reason number 3. So I'll just call it the Fed. And the Fed is anticipating even more increases into 2023. And what that's going to do is it's going to make the cost of borrowing money a lot more expensive for real estate investors, and that's going to impact the kinds of deals that they can do, what they're able to do in the deal, how much leverage they're able to employ. All of that filters in. So we've got 3 big issues right now, 1, 2, and 3. Now, before I get to number 4, I just want to throw this out. Hit the like button, subscribe, leave a comment. We're doing a t-shirt giveaway today. So we have the Mogul in the Making t-shirt. So just leave a comment, let me know, and then Katie will automatically enter you into a draw for the free t-shirt giveaway today. Okay, so number 4, for the top trends to watch out for in 2023, we've got cost and capital availability. So we had, over the past couple of years, we had absolute tsunami of capital flooding into the real estate market. Capital was everywhere, and now the big trend to watch out for number 4 in this list is the cost and the availability of capital. Capital is going to start, shrinking its availability because we've got inflation, we've got the Fed, and that's going to put some strains on investors. So they won't be able to put as much capital out there into the market, and that's going to start eroding away the supply of capital that CRE, commercial real estate, has to deploy. And what that's going to do, that's going to really tighten up the purse strings and really limit on what you can do in a deal, and it's going to really test your investor database and how you can raise those funds. So that's number 4. Now, I forgot. I had a really interesting stat for cost and capital availability. So in terms of cost, so this was a Canadian stat because I like to throw in some US stats and Canadian stats. So construction costs rose 12.8% in Canada in Q1, and then we'll see the full annual number once Q4 finishes up in another week. So construction costs rose 12.8% from the year before, which is just crazy. Like we've seen an absolute increase in costs, and that's owing to inflation and the geopolitical strain on supply chains and all that kind of stuff. All right, so number 5. We've got ESG. Now, ESG is a term, if you're not familiar with it right now, it's going to come up more and more and more because this is the way everything's really pushing right now in commercial real estate, investing in general, and quite frankly, the world. So ESG stands for environmental, social, and governance. And here's a really interesting stat I found. So this is going right back to before COVID. So investors held $17.1 trillion in assets chosen according to ESG principles in 2020. Now you go the year before, that number was 12 trillion. So a huge increase, about $5 trillion increase in terms of investors choosing where to place their capital just based on ESG. So that's environmental, social, and governance. And, if we pare it down to a real estate example, right? So we look at environmental, how environmentally friendly is the building? What are you doing in your building right now to make it, more carbon neutral, or energy saving light fixtures and water saving toilets and taps? These are small things, and now the growing consensus is that the market is actually placing a premium on properties that fit all the ESG requirements. And then there's like the brown discount that they're calling it, where if your property isn't up to standard with these ESGs, then you're going to be pricing in a discount because investors, it's very clear with how the money's going, and the stats just keep going up and up and up in terms of how investors are looking at potential investments and how they want to place their capital. So the social aspect, the governance aspect, and the environmental aspect, very important in investors' eyes. And then number 6 is affordability. Now we have a big housing crisis, not only in Canada, but also in the USA. And it's only getting worse because we've got, inflation on the rise. We've got the central banks on both sides of the border increasing the cost of borrowing money. And what that is doing is that's actually just pricing out more people out of the market. So what we're seeing is a lot of people who could have bought a house maybe a couple of years ago, now they're staying renters longer, and that's absolutely going to impact multifamily investors with apartment buildings, and that's going to increase the tenant pool. And what that's going to do is going to put further pressure on vacancy rates. And an interesting stat I found yesterday was that multifamily vacancies are at a 5-year low right now, according to Moody Analytics. So multifamily vacancies are at 4.4%. And that is a 5-year low. So even though we have all of this stuff going on, that's just increasing the occupancy rate in multifamily, and that's going to put more upwards pressure on rents, especially with inflation, as everybody keeps pace with that. So a lot of things going on in the commercial real estate space, but I just wanted to highlight these 6 things, these 6 trends to watch out for in 2023. Geopolitical, and this is what the really big guys are watching out for right now. We've got inflation, interest rate increases with the Fed. We've got costs and the cost and the capital, ESG, and then also affordability. So as we're looking into 2023 and thinking about, well, what can affect my portfolio? What can affect my business plan going forward? I would take a look at these 6. And once we bring Victor on, I'm sure we'll have a whole lot more discussion about these, plus some other things to watch out for in 2023. So right before we put Victor on, just another quick reminder, hit the like button, leave a comment, ask some questions once Victor comes on, and Katie will put you into the draw for the free t-shirt today. We got Mogul in the making, and then you were also automatically entered into our monthly draw for a free loaded elite ticket to the multifamily conference. So we'll take a quick break. We'll bring Victor on, and I'll see you in a minute. Stay tuned. All right, welcome back to Wealth Wednesdays. Victor, very nice to see you. Thanks for hopping on today.
Great to be here.
Yeah, really looking forward to this. You are someone who has a lot of experience in the world of commercial real estate, and I've got some gray hairs, but you've got a couple more than I do. So I'm always interested in speaking with people with your level of experience, because you've seen things happen in the real estate market, and I think we can always learn from people with as much experience as you. So thank you very much.
Oh, great to be here.
Yeah, so I'm curious, because you've got experience in you've got a lot of experience in different asset classes like multifamily. You've done development, self-storage, senior housing. What was the asset that you first cut your teeth into? Like, how did you get started?
So my very first start, I mean, it's taking me back now. So I got my start in the industry, in the tech industry. Actually, I started out as a microprocessor designer and rose through the ranks of both private and public companies. Have chips in all kinds of weird and wonderful applications all over the world, everything from cellular base stations to have a chip in the Patriot missile, and pachinko Apache slot machines in Japan with Sammy Sega and NVIDIA, all kinds of crazy stuff. And it was 2006, I bought my first small real estate investment. It was a condo within walking distance of Parliament here in Ottawa. And what I saw at that time, Airbnb didn't exist. I saw a nascent market for folks that needed a medium-term rental, fully furnished, for parliamentary staff, embassy staff. And that's really where I started, is buying units within walking distance of Parliament, because nobody was born a developer. Everyone got their start with that little white house on the corner, whatever. In my case, it was a condo 4 blocks from Parliament.
Yeah, no, that's really interesting. And, like myself included, I started off in residential real estate, and I think a lot of people do. You buy that condo, or you buy that first duplex or a triplex or a detached home, whatever it is. And then what was it that got you into the commercial side of real estate? What was there a particular thing that happened, or a deal?
Well, it was a couple of things. So 2007, 8, and 9, I was VP of engineering of a company based in Montreal. We were building a new cellular network in Japan with the number 4 carrier in Japan. And I was traveling back and forth to Tokyo every 2 weeks. So it was a little bit punishing on the body, that 13-hour flight from Toronto to Narita Airport, and the 12-hour time zone difference, every week. And so I literally resigned my position as VP of engineering and decided to move into the world of investing on a full-time basis. Now, you might remember something was going on in particular in the US right around 2009 that looked like the opportunity of a lifetime, which it was, although there might be another one just around the corner. And decided to start divesting of some of those initial investments, or at least repurposing capital south of the border. So I made my first investment in the US in 2010, and it was a multifamily building, it was an 8-unit building, and then just move forward from there. So that was really the very first step.
Yeah, gotcha. And one of the things that we hear a lot from people is that you always have to focus and just become a master at one niche. Now you have experience in a wide variety of different niches within commercial real estate. So,
Right.
um, is there a reason, or is there something that drove you to diversify? Was that always part of your strategy, or or like you know and how do you actually become a master at all those different niches rather than focusing on just one?
Yeah, it's a great question. And we looked at it from it's a little bit opportunistic. So we don't typically go hunting for deals today. I would say without exception, they all come to us. And I say that with all humility, but at a certain point, when you develop a reputation for execution and for attracting capital, deals come to you. And that's been our experience. So today, for example, like you said, we're in multifamily, senior housing, storage. We're doing quite a bit of land development. We have close to 2,000 acres of various residential subdivisions that we're doing across multiple markets. And we've developed an expertise in all of those, but we've done so incrementally. So, for example, where we really got started in multifamily investing on a larger scale was in the Philadelphia market. We started acquiring properties within the core of the city in North Philly within a 10 block radius, probably acquired, I don't know, 85, 90 properties within a 10 block radius, and started putting together land assemblies. Now, in the world of land development, there's really two ways to make money. You can take raw land and you carve it up into smaller pieces, or you take developed land and assemble it back together. Those are the two principal methods. And of course, the value of the land is tied to what you can do with it. Agricultural land, pretty much anywhere in the country, is anywhere from 3 to 10,000 an acre. If you're growing wheat on it, maybe a little bit more, but it's in that range. You can start to put residential houses on it with a density of 4 to 6 units an acre. You're probably a few 100,000 an acre. You put a 40-story high-rise building on it, now you're into the millions per acre. So it's all tied to what you can do with the land. Of course, the demand has to be there to support that asset, but it's all tied to what you can do with it. And so we came at it incrementally. If you think back to 2011, 2012, even in the Philadelphia market back then, you could buy things for far below construction costs, so it didn't make sense to build. So we started buying properties in the inner core of the city, demolishing the inside of the buildings, keeping the structure and putting a new building on the inside, because in that time, there was so little new construction, there was a lot of pent-up demand. So we started there, and then from there we said, well, some of these are too far gone, let's demolish them and do new builds. So we then got into new builds, and then we said, well, let's see if we can get more density. So every step along the way, we added one more thing so that we got, developed more skill in the process. And we're now doing ground up development. We're doing large scale entitlements. I mean, our largest project in Colorado Springs is 1,783 acres. It'll be a large master plan community. And we just developed that expertise incrementally over time.
Yeah, gotcha. And one of the things before we took the break, I was talking about 2023 and some trends to watch for. I'm really interested in your opinion on what's going to happen next year. You kind of teased that there might be a good opportunity,
Yeah.
just because you have your fingers and you're in the trenches in so many different places. Can you just break down, I guess, a macro overview of what you think is going to happen, and maybe we can dive a little bit deeper into each one as we go?
I like to break things down into acute problems and chronic problems. Acute problems are the ones where there's a real burning opportunity. Chronic problems are ones that, it's like a rock in your shoe. You'll put up with it for a lot longer than you probably should.
Yeah.
But it's those acute problems. So we've gone through a massive change in the last year with interest rates spiking. A lot of the multifamily value add deals that were done in the last year, probably 90%, and that's not a don't quote me on that number, but it's in that range. Probably 90% of those were done with bridge debt in one form or another. And if you go through the underwriting of those deals, when they would have been conceived, those projects would have had some form of cash out refinance at the end to get into permanent financing. You rerun the analysis with today's interest rates, those interest rates would have been in the high twos to low threes. And now those interest rates are in the fives and sixes, and in some cases even the sevens. So when you redo the math on those, what you find is not only are you not going to get a cash out refinance, you have to write a big, huge check to get into permanent financing. So if you're the sponsor with that project in your hands, your choices are very limited. You do a massive capital call from your existing investors. That's not going to go well. You try and bring in new equity, which will be dilutive to the existing investors. Well, what do you have to sell? It's not a great value proposition. Or you sell, or you try and extend and hope for better days. You try and extend that bridge loan until you run out of extensions. That's the reality of the marketplace today, because today that permanent financing is going to be debt coverage limited. You're not going to get your 75 or 80% loan to value. You're going to be at 55, 58% loan to value in order to meet your debt coverage requirement. And that's the reality. So because of that, I'm expecting to see, once those extensions run out, a number of distressed properties come into the marketplace. Now, we had this phenomenon during the pandemic as well, but there was one key difference. So a lot of value add deals got done. They didn't get finished because of supply chain issues. So they had delays, they had cost overruns, but wallpapered over it was rent growth. Rent growth was extraordinary during those 2 years of the pandemic. That's not sustainable. That's not going to continue in this economic cycle. So that wallpapered over it, and people were still able to come out with their skin, come out alive on the back end of that. I think that's changed now. So I'm expecting to see a lot of distressed assets come into the market in the next 12 to 18 months.
Yeah, no, absolutely. And looking at self-storage, obviously different drivers and dynamics at play there. You're involved in self-storage. How are you looking at your portfolio now in terms of the units you own? And are you looking to acquire some more over the next 12 to 18 months? Like, do you see any impacts there?
Yeah, so the storage market is going through a fairly slow transition. It's an attractive market, but it also breaks down into multiple asset classes as well. There's your traditional self-storage that overwhelmingly has been a cottage industry pretty much all over North America. And the institutional players have, recognized that it's an attractive business. The institutional players, a lot of REIT money coming into storage these days, and it makes up probably about 25% of the market today. It was only 15% of the market a couple of years ago, but still the majority of the market is a cottage industry. Primary markets are probably oversupplied today with a lot of institutional money that's come in, but there's still a lot of opportunity in secondary and tertiary markets. So that's where we're active. We see opportunity in secondary and tertiary markets for product enhancement. So there's a lot of not climate controlled product in those markets. There's a shortage of climate controlled. So in some cases, we're building. In other cases, there is a shortage of boat and RV storage. In other cases, municipal ordinances have changed and there needs to be equipment laydown yards for commercial. If you've got a fleet of tractors and backhoes and all of that kind of equipment, where do you put it? You're not leaving it in your laneway. Your HOA is not going to allow that. So there's an increasing need for construction equipment for contractor yards and things like that. So we break down the market into those specific asset classes. And of course, just like any real estate, it's hyper-local.
Yeah, no, absolutely. Have you considered getting into the office sector at all? Because it's taken a hit. Like, for instance, in San Francisco, you had a vacancy rate of 6% before the pandemic, and now it's over 15%. So have you thought about dabbling? Sorry,
28%.
28% now. Okay, I must be reading a wrong stat.
In the downtown core, there's over 10 million in the financial district. 10 million vacant. Well, not vacant, available. So that's both space available for sublet. Someone's paying the rent, but it's available, so it's significant. And we're
Yeah.
seeing the same thing in the core of a lot of major cities, even the downtown of Houston, 22%. So it's not just San Francisco. We're seeing it in New York as well. A lot of office vacancy, especially in Midtown. Now, traditionally, when you think about office, you look at it and say, okay, well, that's a lot of vacancy. There's going to be a lot of rent concessions. The tenants are absolutely in the driver's seat. Frankly, I'm not a fan of owning assets with that much uncertainty unless I'm really buying it for pennies on the dollar. Now, some people are looking at buildings with a view to repurposing them, maybe converting them to residential. But you've got to think about the physics of those buildings. Like if you have a building, think about New York City, where a lot of these office buildings are 200 feet by 200 feet. The building has too much area in the core for you to build apartments. Apartment buildings, at least in one dimension, need to be a maximum of 90 to 100 feet deep. Otherwise, there's just too much area in the core. There's only so many bathrooms and laundry rooms and closets that you can put in the core of a building. You need windows for bedrooms and for living rooms. So not all buildings lend themselves to residential conversion. Only a small subset do.
Mhm. Yeah. So I guess, would there be a time, in the next 12 months where you might consider it? Or like you said, you want to be paying pennies on the dollar?
I think you want to be paying pennies on the dollar. I think
Yeah.
that's the key. Even if I think about, for example, the city of Ottawa, we've gone through a decade where rents have hardly moved in the city of Ottawa. We've had the federal government refurbishing millions of square feet in the downtown core. They pulled people out of the downtown core into swing space in the suburbs. And now that swing space is going to become available. Who's going to occupy those millions of square feet in the suburbs once those people return to downtown, even if they do return to the office, because many of them are still in the hybrid model? So I think what the pandemic did is it accelerated a trend that would have taken 25 years to achieve, and it just compressed it into a couple of years. And it's not going to return to normal. There'll be a new normal, and we don't quite know what that is yet.
Yeah. And on the development side, how has your company worked around the increase in costs and all the delays? Because obviously, you throw out some really big numbers in terms of the amount of land you're developing.
Yeah.
Obviously, cost rising can have a pretty dramatic impact. So, what are some of the things you've been doing to stick handle around that?
Well, we've seen, depends on the asset, on the type of construction. So, for example, stick build, wood frame construction, we've seen lumber prices peak in May of 2022 at $1,450 per thousand board foot. Today, we're probably around $450 per thousand board foot. So, lumber prices have come down significantly. Where we've seen significant price increases have been in mechanical, HVAC, things like that. Those prices are up, and those are probably going to stay up. But we've seen even gypsum board, things like that, those prices started to come down. So we've seen $20, $25 per square foot reduction in construction cost in the last 3 to 4 months. So things are starting to normalize. Labor is starting to normalize again. Folks that said that they were busy for the next 18 months are now approaching us on one knee asking if we have any work. So it's a different environment. People are getting a lot more reasonable about pricing.
Mm-hmm.
Where we're still seeing supply issues are windows and doors. And all the major North American, even the largest manufacturers, have extended lead times. Doors that were quoted at 56 days are probably going to come in 120 days. Windows that were quoted at 8 weeks are coming in at 14. All of the manufacturers are suffering right now for those two particular items.
Yeah, gotcha. And one of the things that people always ask, and always like to ask this of guests, let's imagine for a second that you still have your experience, but you're starting your company again from scratch, and we've got the next 12 to 18 months ahead of you. And you've got everything but you're starting from zero. Can you walk us through how you would start to rebuild your company from today?
That's a little bit of lessons to younger self type question.
Yeah.
I think if I was the mistakes that I made early on, I kind of had to relearn lessons that frankly I already knew, and it's actually humbling to admit that I was doing projects that were too small. Because in the world of investing, yes, these projects are big, and people often look at their bank account and say, well, capital is the limiting factor, so I'm going to start small. But the problem is, all of these businesses are active businesses. And all active businesses, I don't care what the business is, it could be a software company, a restaurant, a hotel, whatever, they all need the same basic functions. You know, you need financial management, you need operations, you need quality assurance, you need marketing, you need your internal systems and processes. You need all of these functions. Doesn't matter what the business is, and nobody possesses all the skills. In fact, there are 7 discrete functions that form the minimum for any business. So now the listener is probably saying, well, Victor, how on earth am I going to feed 7 families? I haven't figured out how to feed 1 family yet. Well, the problem is that if you start small, you can't attract enough of the skills to get escape velocity. You'll get stuck in a low Earth orbit that you will never, ever escape. And that's the problem. So if you start to approach projects that are a little bit bigger, then those projects can generate enough profit, enough income to feed those vital functions that you need to have a sustainable business. If you try and stay small, you're going to get stuck. And that's the problem. And it happened to me. I got stuck. So if I was to start again, I would do exactly what we're doing today. And that is, I would attract the top talent and make sure that we're working on projects that are of sufficient scale that that they can be sustainable. Because I mean, think about it. If let's say you're charging a developer fee, and I'm not suggesting that you go into this business for the purpose of getting rich off of fees, because that doesn't work. But if the purpose of a developer fee is to feed the vital functions, and let's say we're doing a $40 million project, and I'm just going to pick round numbers. And let's say your developer fee is 4% of your cost. So 4% of $40 million is $1.6 million. Spread that over a couple of years. Do you think I can hire some talent for $1.6 million and have a sustainable business? Absolutely. But if I'm trying to do a $400,000 condo conversion or condo flip or something like that, there's no money there. How are you going to pull together a team? Well, I'll do 100 of them. Yeah, that's it. It doesn't work.
Yeah.
Doesn't work.
And then you end up wearing too many hats because you have to do everything on your own and you burn out.
Right.
So, yeah. So I guess that the natural question after that is, okay, so if somebody is in smaller deals right now and they're looking to upsize and get into the bigger stuff, obviously they have to attract more capital. Where does somebody even start looking for investors in the first place? Everybody always says family and friends, but how would you approach capital raising if you were starting from scratch again?
I learned to raise capital in the tech industry, and what I discovered along the way was that sometimes raising capital was incredibly easy. And then when I moved into the world of real estate investing, I rediscovered the process and then discovered it was exactly the same. And so I wrote a book, and I'm not here to plug my book, but
plug your book. Let us know what it's called.
So the book's called Magnetic Capital, and the premise of the book is really what I learned from rediscovering that process. That when you're raising capital, you need 5 elements, and briefly, those elements are: number 1, you got to have relationship with the capital. Number 2, you have to establish that psychological contract of trust. Number 3, you have to point to results, show me your track record. Number 4, you've got to have a compelling opportunity. And that's where most people start, by the way, but notice it's 4th on the list. And number 5, you've got to have alignment between the goals for the money and the goals for the project. And if you don't have all 5 of those elements, raising the money is going to be incredibly difficult. But when you have all 5 of those, it's actually remarkably easy. Now we could talk for an hour if you want on just those 5 elements. But think about it. Would you part, if you're a high net worth family, would you part with millions of dollars of your life savings that you've built with someone you had no relationship with? Of course not. It doesn't make any sense, right? the psychological contract of trust is not just, is this an honest person? It's making sure that all of those commitments that you make are met. Can I trust you to hire a good team? Can I trust you to put together a good plan? Can I trust you to execute the plan? Can I trust you with my money? Can I trust you to communicate in an open and transparent way? And on and on and on. All of these things build that contract of trust. It's not something to be manipulated, it's something to be earned. And then number three is the track record. And you say, well, how am I going to raise money if I don't have a track record? Well, this is not like your grade 3 math test that if you collaborate, you're cheating. You got to find people that are willing to work with you that have a track record. So, for example, one of my partners in the US, his name is Bob, and he's built so far 10,000 units in his career. He's a HUD sponsor, very established. And folks look at me and say, well, Victor, you're a relative rookie, which is true. But then I've got my partner, Bob, and I push him to the front and put forward Bob's track record. And then that takes that whole conversation off the table. So align yourself with the right people that have the track record so you can borrow from some of their track record legitimately. In terms of compelling opportunity, it's a little bit like, what's beautiful is it in the eye of the beholder. For some people, it might be a medical office building at an 8% cap rate. That might be their definition of beauty. For someone else, it might be a senior housing facility at 93% occupancy. It varies. So you've got to figure out what that is for that particular investor. And then finally, the alignment piece is understanding what the agenda for the money is. What is the size of the investment? What's the term of the investment? What's the rate of return? What's the security? What's the tax consequence? What's the control structure? And on and on and on. There's about a dozen of them. And the more sophisticated investors are very clear on what their criteria are. And you will get a fast no, which is really what you want. The worst thing you want is a very slow no where it's seductive and it looks like it almost works. But of course, things that almost work don't. And you're wasting time. So you want to make sure that you've got that part dialed in and figured out, and you get to really understand what your investors' criteria are. And once you have that, then you've got a realistic shot at raising the money. But don't try and take someone who's never invested in real estate and take them through 180 degrees to look at something completely different. Take someone who's invested maybe in some 50 or 60 unit buildings over here and say, well, that's good. Why don't you look 15 degrees to the left here, and maybe you'll like this 240 unit building a little better. So that's kind of how we approach it.
Yeah, no, that makes total sense. And the name of your book again is Magnetic Capital. So we'll
Correct.
have to get a link for that to put that up there. That's
Sure.
great. Thanks for sharing all that.
My pleasure.
Yeah,
My pleasure.
no, that's great. So I guess before we wrap up here, because we're coming up on time, looking forward to 2023.
Yep.
Are you as excited about 2023 as you were in 2008, 2009? Do you think it'll be somewhat similar?
Yeah, I mean, it's a little bit of a mix because if I think about 2008, 2009, we didn't have a lot of assets, so we could play offense without having to play defense at all. Today, we're involved in a number of projects where we're obviously going to play offense on new opportunities, but we also have to play defense on the existing opportunities. So you got to find that balance, make sure that you're taking care of today's business as well as jumping on the future opportunities. And it's always more fun to play offense than to play defense. That's
Oh, we got somebody who owns your book. Gord says it's a great book. That's awesome. Thanks for chiming in, Gord. That's awesome. So Victor, just want to say, we had a comment from Daly. Katie, do you want to just run through? Do you mind sticking around for a couple minutes to run through some Q&A if we had questions, Victor?
Yeah.
Yeah. Okay. Katie, can you put up some of the questions here? So Daly's saying you do a lot of different things and clearly have an excellent team. What are the key takeaways or advice to scale your team and processes to scale efficiently and quickly?
The challenge for any business owner is to grow ahead of the revenue curve. That's the number one thing. So oftentimes you say, well, I know I need more help in marketing. How am I going to go fund that? I haven't got the revenue to support that yet. Or, and It doesn't matter what the function is. You're always looking to grow ahead of the curve. So one of the ways that we've actually been enormously successful is by bringing in folks as interns, believe it or not. Now, most internships, if you're just getting the leftovers from someone who's got a full-time job and they're trying to juggle a million things and kids and grandparents and all the rest, and you're only getting the leftovers, is probably not going to work. But if you get someone who comes in at a high skill level, who is prepared to give, because you're trying to run a real live business here with deadlines and deliverables and all the rest, where we've had very good success, and these programs exist both in Canada and the US, is in folks that are transitioning out of the military into the civilian workforce. And oftentimes the military will pay for them to intern with you for a period of time as they make their transition to civilian life. Sometimes it's someone on a medical leave or all kinds of different scenarios. There's a program in the United States called Skills Bridge where the armed forces will pay for, I think, up to 6 months someone to intern in your business. So those types of programs are, very, very effective at bringing talent in. And you want to bring in folks that have some officer training, but you don't want 4-star generals because they're not used to rolling up their sleeves. You want folks that are maybe at a little bit more junior level, a sergeant or a warrant officer, someone like that, that's got initiative, that's willing to roll up their sleeves, they're willing to learn and train people. That's another key thing, and they've got discipline and all of those things. So that could be a very effective way of bringing people in.
Yeah, actually, I'm so glad you mentioned that because that was not even on my radar. So that's a great resource. And I guess just to go further with that question, the one thing, especially for me, I've learned as our team grows, is each time we grow the team, it highlights another. I guess weak point in myself as a manager because now I have to effectively lead these people. So, what are some nuggets that you've learned in terms of managing that team once you've started assembling it that might be able to help us out?
That's a great question. That's a really good question. I've brought my leadership skills that have been developed over years in the tech industry, and I had the good fortune of many of those companies throwing a lot of training resources at me, whether it was Center for Creative Leadership or a whole variety of different things that forced me to go through a development process that involves what's called four-way feedback. This is where you might fill out let's say the California Psychological Survey, or some of these other instruments that really look at your attributes. But not only do you do it yourself, you get your manager to do it, and your peers and your subordinates, and you get this 360-degree view of who Victor is as an individual, as a leader. And the first time I went through that, it was very confronting. Um, and I personally went through that process of denial, then anger, then acceptance, and then finally growth. Um, because at first I was frankly not a very good leader. I was a terrible manager. I was a terrible communicator. And but it's something that can be developed. And we all have those strengths and weaknesses. So sometimes it's figuring out how to develop those leadership skills so you can be that leader in the organization. Sometimes it's a matter of bringing in a mentor who can help you with that. Someone with experience who can you can bounce these ideas off of, who isn't someone with line responsibility. Often I really gravitate to folks that are in their 70s, 80s, and 90s. They've got a tremendous amount of wisdom, and if they've been enormously successful in their career, they're usually willing to share it and give really high quality sage advice, because a lot of these principles are timeless, absolutely timeless, in terms of what people need, in terms of what they're looking for out of a leader. So I would definitely make those personal investments in developing yourself as a leader, finding those captains of industry that are willing to take you under their wing and really teach you.
Yeah, no, that's a great answer, and that for myself, just speaking personally, every day I'm challenged as we grow our team. And I'm always learning about how I can do a better job to effectively lead the team. And one thing I found is when I failed as a leader, it hurts the team. So I'm always looking for ways to improve. So thank you very much. And I think Katie, I think we're good to go. So all that's left, I just have to announce the T-shirt draw winner. So Victor, thank you so much. If somebody's interested in getting your book or any of the other resources you have, Victor, where can they get a copy?
The book is easily available on Amazon, and I also host the Real Estate Espresso podcast, which is a daily show 7 days a week. And I believe episode 1803 dropped today, so I've been doing it a little while, and I would love to engage with your listeners that way. So the weekday shows are literally just 5 minutes, myself only, and the weekend edition are interviews with notable people from the world of real estate investing.
That's great. Well, Victor, thanks again. We learned a ton, and I really appreciate your insights into next year and what it takes to grow a very successful business. So thank you very much.
Thanks very much.
All right, so we just have to announce the winner for our T-shirt draw, and Katie has selected Gord Mackey. Gord, you have won a free T-shirt, Mogul in the making. So all you have to do is get in touch with Katie. All we need is your address and your size, and we will get that into the mail straight away for you. So thank you very much for joining me. We will see you on Monday for Multifamily Mondays, 12 p.m. Eastern Standard Time. Until next time, happy investing.